Welcome back to How Real Estate Changed My Life. And if you've listened to any episodes up to this point, the whole thing is I want people to understand that real estate investing is very attainable, and there's so many stereotypes that are not true. There's a lot of different ways to invest in real estate, and there's a lot of different ways that it impacts you for the good in the long term, especially, that people don't talk about. And today, I'm very blessed to have an expert in what's called 1031 tax deferred exchanges, LuAnn, who is unbelievable. I've done multiple transactions with her. My clients have done multiple transactions with her, and they've all gone fabulously well. But I'm going to let her talk about what a 1031 is and how it benefits you in the long run, and give some real life examples and kind of how she ended up in this business. But with that, LuAnn, introduce yourself. I want you to just tell us all that you know, and really let it, like you mentioned earlier before we started the podcast, is in a layman's term where everybody understands it. Because I think so many people have been afraid of them because they don't know what it is, because taxes and all that. So go ahead
Okay,
and tell us.
I can do that. So my name is LuAnn Blough. I live in Carrollton, work out of my house, work for Exchange Resource Group, which is a qualified intermediary. I work for 3 real estate attorneys. They are in Denver, and I've worked remote for them for 11 years. I learned from the ground up. So I think I can explain. So why would you want to do a 1031 exchange? If you've owned an investment property for longer than a year and a day, then when you sell it, you're going to be taxed on the long-term capital gains as opposed to short-term. 2 different parts of the tax code. If you're a flipper and you just buy houses, rehab them and sell them, that short-term capital gains 1031 exchange should not work for you. But if you've held it for investment, business, trade, or investment, then when you sell it, if you want to defer your capital gains and your depreciation recapture, that's something that a lot of people don't know. And I won't.
It's huge.
Yeah. And do you want me to go into how they calculate the basis or not?
I
Is that
think
too
that
much?
wouldn't be a bad idea, because I don't think people understand because people are used to, like, when you buy a stock at 10, you sell it for 100, got $90 profit. With houses, it's different because of the depreciation. So I think people don't think about that.
So and a lot of people think that they don't have to reinvest the amount of their loan payoff, which is a sad thing I have to tell them.
Mhm.
But when you're figuring out how much tax you have to pay, and your CPA can help you with this, we have a tax calculator on our website, but you take the original purchase price, what you paid for the house, add the amount of capital improvements you've done over the years, and subtract the amount of depreciation that you've taken. Whatever that number comes out to be is called your cost basis in the property. So when your accountant will figure out your tax hit without the exchange, they're going to look at the difference between your cost basis and your sales price, but you can deduct your seller paid closing costs from your sales price. So does that make sense, Kyle? Okay. Okay, good. And the rate, federal tax, is either 15 or 20%. If you own real estate, you're going to be in the 20%. 20% of the gain, and then 25% of the depreciation recapture. In Texas, we don't have a state capital gains tax. Tennessee, Florida, 3 other states, and I cannot remember the ones that don't have it. But say if you're in California and you're selling an investment property, you're going to pay 20% federal on the gain, and I think it's up to 14.8% on the state tax. So that is like a significant amount of your profit. So 1031 exchange has actually been around for 103 years. And the government, the IRS, put it in there to get more real estate in the market. So instead of paying that money in tax, you can defer it and you can buy more real estate. You can buy anything defined as real estate. That's another misnomer. This 1031 is like kind real estate. That doesn't mean single family for single family. That could mean single family for a commercial building. It could mean a commercial building for, in Texas, oil and gas mineral rights. You can sell oil and gas mineral rights and buy real estate. You could buy a condo at the beach that you can use a little bit themselves. There's some parameters on that. Any of the 50 states plus Guam and the Virgin Islands. And the reason the U.S. Virgin Islands is there is a senator back in the 70s named Charlie Rangel, and he owned a boatload of property in the U.S. Virgin Islands. So he wrangled and got the U.S. Virgin Islands added. So that is why you're going to want to use a 1031 exchange, so you can defer, so that you can grow your portfolio if you keep going. You set up an estate planning for your heirs. Once you pass away, if my boss Dan McCabe was here, he'd say you defer, 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 and then you die.
Yeah.
But your heirs will inherit that real estate at a stepped up basis. So say you had $3 million of portfolio and you pass away, instead of paying the tax that you would have paid had you decided to cash out. Because once you start with the 1031 exchange, it's best to keep going. Otherwise, you are going to pay some tax. But yeah, they inherited a stepped up basis. If they decide they want to sell it at $3 million, they're not going to pay any tax. Mm-hmm. If they hold it for a while and it goes up in value, say it goes to $3.5 million, they would only pay tax on the $500,000 of gain since the date they inherited, which would have been $3 million. So it's a pretty cool thing.
I know, and so there's when people, like, the thing is never pay taxes, because I mean if you can just not pay that 20% tax and just reinvest all of that,
yeah,
that's a huge impact on net worth. So if you were to have one house, have good equity in it, you sell it, don't pay the taxes, but you use all of the proceeds to go buy two more houses with that down payment. Now you got two houses that are appreciating value at the same time, and you're still paying down the mortgages. So basically, you get a free house out of the deal, and then you just keep doing it every 5 to 7 years. How often do people that are really playing the game right, how often do they trade up?
I'm starting to hear, that's interesting you asked that, because I think the last couple months I've heard from several clients that we did exchanges for in 2020. So I don't know if there's a usual. It kind of depends on what their goals are. Mm-hmm. But I would say 3 to 5 years. It also depends on the amount of appreciation.
Yeah.
That they got.
This year's a little rough for us on the appreciation.
This year's a little rough.
Yeah, and I've not done a good job of being aggressive on that regard, because I would, you always hear like buy it and pay it down and you have a paid off house. That's great. You have one house paid off, but if by trading more often, you get a lot more houses and you still get the same principal pay down, significantly more really, as opposed to just having one house. So that's something that I was probably late in the game picking up on, the 1031 magnitude of how much of an impact that it can make. So I want to make sure everybody understands that this is
we'll have to do my 1 hour Zoom class with slides at some point, because I've got some slides that show just how wide the disparity gets. So we've got investor A and investor B. One exchanges, one doesn't. It goes from 1 year to 5 years to 10 years to 20. And the amount of real estate that they can purchase doing the exchange it's staggering how much more you can.
It is. So I was fortunate enough. I had some little townhomes that I bought dirt cheap, had some really good appreciation in them, and was able to transfer that in without paying any taxes, more than doubled in value. And I rolled it into a vacation home. And like, I never would have thought I would own something like that. But just because of these little dinky townhomes, it worked out. It was a shockingly, yeah, it was. And so that's another question I wanted to hit with you is, this all sounds fine and dandy. And, we always get people trying to sell us stuff, ideas of, oh, do this and it'll save money, or do this and it'll make more money. You make it sound so easy. So tell us, what is the actual process on doing a 1031? Is it something scary and complicated?
Let me go through the rules. Because it's the IRS, and there are 6 official ones, and I added my own 7th, because you have to set the 1031 exchange up before you close on the property, which is where you come in, and Melanie, because you're telling your people about it before they close. Sometimes I'll get calls and they'll say, I closed on my property 5 days ago. Now I want to set up my exchange. Well, they can't, because one of the rules of the exchange is you can't have constructive control over the funds.
Right.
So that's where we step in as another rule is that you need a totally independent third party, an intermediary, and that's what we are. So we step in when there's a contract on the property to be sold, get it set up their bank account. We don't hold any money internally. We have two banks that we use, and the money's all held in segregated accounts just for our clients. We have to verify vesting. So another rule of the 1031 exchange is whatever taxpayer ID is on title on the sale has to be the same taxpayer ID that's on title on the purchase. Mm-hmm. So I think your mom, it's Melinda's your mom, right? Yeah, Melinda's, yeah. I think hers were in her personal name, and when you have that social security number as your taxpayer ID. Some people want to buy in LLCs when they sell personally, which there is a way to do that. They just have to set up called a single member disregarded entity. Mm-hmm. So it's an LLC you can set up for liability purpose, but it still passes through to your social security number. Mm-hmm. So we have to check all that. We get the contract, the title commitment, send the wording to the title company so that it shows in case there was ever an audit that they did do a 1031 exchange. And then money goes into your exchange account, and that triggers two more rules. So you have 45 calendar days from the date you close on the sale to identify the replacement properties. We send a form out, the 45-day ID form that doesn't go to the IRS, but we need it back for the file. And once day 45 hits, you have to buy one or more properties on that list. You can change your mind 200 times during the 45 days. Mm-hmm. But on day 46, you have to be locked in to purchase one or more of the properties that you want to buy. I think one of your questions to me was how many properties they could identify. Was that on that list that you sent me?
It was something to cover. I think it's important to mention.
It is. So you can identify 3 properties. And again, they can be anything defined as real estate. And bare land is always real estate, even if you're not going to lease it or anything. But as long as you buy bare land, you're going to buy it in the hopes that it appreciates, because why else would you buy it? So up to 3 properties with unlimited value. So Kyle, say you sold for $300,000. And you found 3 properties worth $2 million each that you had the money and you wanted to identify, that's fine. If you decide to identify more than 3, then there's a rule, there's a cap that goes in on the value of those properties. And we would have to take your $300,000 sales price, multiply it times 2, because it's called the 200% rule. So that would be 600,000, right?
Okay.
So if you identified 4 properties, the total value of the properties that you identify could not be greater than 600,000. This is the most confusing part of the whole rules, I think. Mm-hmm. If you stick to 1 or 2 or 3, then that rule doesn't kick in. So most of the time when I'm working with people that are selling single families, I suggest that they stick to 1 or 2 or 3. Unless it's, if it's a high dollar property and they want to buy smaller properties, then yes, they can identify more than 3. But in general, I would say stick to 1 or 2 or 3. Mm-hmm. And that's the 45-day rule. And that kicks in on the date of the settlement statement. The other timeline that kicks in is the 180-day deadline. So from the date you close on the sale, you have 180 days to purchase 1 or more of the properties that's on your 45-day list. We don't normally run into problems with 180 days unless a property that you want to buy is in probate. And we've had a couple of those fail because they don't get them out of court. Mm-hmm. The other thing is I will never recommend people is to buy a new build that hasn't been started yet. Because a builder may tell you that they're going to get it done in 180 days, but experience has shown that they don't, and they have another buyer in the wings waiting. So new builds are fine. There's a lot of Lennar building a ton of homes, affordable, but people are buying them, but they're buying them when they're just almost finished, or identifying them when they're almost finished.
Yeah, it's risky because that could cost you 20% in taxes.
Yes, it's very, yeah. COVID, I had like four people that were just so committed to buying these houses, and the builder didn't get them done, and the builder didn't care. The ones that they were up in Oklahoma, most of them.
Well, the prices were
Um,
going up daily for them at that point in time, so they could have
they
sold a lot
were.
more.
Then they didn't have the inventory. I mean, there wasn't the inventory. I think there's a little bit more inventory out now, don't you think?
Oh yeah, there certainly is.
Lot more choices for buyers. So,
Mhm.
all right. So we set it up before closing. 45 days, 180 days. You have to use an intermediary. Um, Title requirements. You have to buy in the same taxpayer ID that you're selling in. And if you're single when you buy a house and then you get married and you file a joint tax return, your spouse can be on that new buy too.
Okay.
That's not a problem. And then how much do I have to reinvest to totally defer the taxes? And this is where there is some confusion. So the IRS says that your reinvestment goal is going to be the amount of any note payoff. So let's go back to your $300,000 house.
Sure.
Say you had a $150,000 note to be paid off, and say you had $30,000 worth of closing costs. So your reinvestment goal would be $150,000 note payoff plus it'd be 130,000. No, yeah, 130,000 that would go to the exchange because it'd be net of your closing costs. So your reinvestment goal was going to be total purchase price of 270,000.
Okay.
A
And that's
lot of times
news because I keep thinking it's the contract price, but it's not. You get to subtract out a little bit.
you do, yeah, because
Yeah.
we're not going to have the cash for those.
Right.
So yeah, you absolutely get to subtract that, but I will get argued on that point. But
Mhm.
we don't have the cash. Well, you have to replace the amount of the debt. You don't have to do it with a loan. If you have cash, you can do it with cash. But yeah, all in. If you don't spend it all, that doesn't destroy the exchange. You're just going to pay tax on the difference between what you should have spent and what you ended up spending.
Okay, so it doesn't
So,
bust the whole deal. It's just a little bit, a little percentage.
right. We just
Okay.
have to make sure it's a big enough percentage. I mean, that you buy up
Hmm.
enough that it's going to, you don't want to end up paying more tax than you would have because the way they calculate it's kind of weird. So if you bought a house for 250, you would pay tax on 20,000.
Hmm.
Um, it's first dollar in, first dollar out when they're calculating that. You also have to spend the total amount of the cash that goes to the exchange. So say you didn't spend all the cash, say you didn't buy enough property, the IRS would look at which hits you more,
Hmm.
the tax on the cash that's left on, or the tax on the difference between what you spent and what you should have spent.
Yeah. Another piece is it's not one house to one house. It can be one house to two houses or three houses to one. So I did three townhomes into one house. So it doesn't have to be one for one. It can be two for one or one for two.
Oh yeah, and you can combine money from the different exchanges. You just have to make sure that you have whatever you're going to buy closed on 180 days from the sale of the first. So if you're selling three different properties, the timeline starts on the sale of the first.
Yeah, that's great. I'm so glad that I've got you here to explain this in layman's terms of what's out there. And going back to my question earlier, like how difficult is it to do? It's not. Like I literally I was scared of doing a 1031 because I hate paperwork, all that, and I literally gave my contact information to the title company for you and the contract, and y'all just did it all, and I just have to go to closing and sign maybe one or two extra pieces of paper. And that was
Closing on the sale, the documents are 26 pages, but you only have to sign it like two or three places. It's a lot of documents. When you go to buy, there's two documents. There's a assignment document so that nanosecond that we are sending the money, you have to sign it to the exchange for that itty bitty time. It's all direct deed. We don't sign any other papers except for the settlement statement. You also have to sign a wire authorization form and fill in the amount that you want us to send. And we sign off on it. We're real careful with security. There was some fraud. I don't know if you ever heard about this back in 07, 08. It was a title company named Land America Commonwealth Title, and they held money internally. Dan McCabe, who's in his mid 70s now, he does consulting for us, but he was in the business then at a different company, and he saw all this go down. So they combined funds, which is why we have everybody in segregated accounts for each exchange. They took the money and they invested it in stock options. And then I don't know if you're too young, probably remember when the stock market crashed back in 07, 08.
I was in the business.
Yeah, okay. So you're okay. Um, but there was $200 million worth of exchange money tied up. And the company went out of business, and the president of that exchange company went to jail. And the very first class I taught 10 years ago, 11 years ago, there was a lady, it was Timeo's title over in Fort Worth. They're not, I don't know if they're around anymore or not, but she was just giving me these hateful glances the whole time I was teaching the class. And I went up afterwards and said, "Have I offended you?" And she said, "I hate 1031s. I've lost my job. I work for Land America Commonwealth
Mm.
Title." So yeah, so we're at independence. We're not very big, but I think that's why we can give such good customer service. You've got some title companies that have in-house 1031 exchange companies. But from what I've heard and from what you said, from our Google reviews, we are a lot more personal.
It was just
Time.
smooth and easy. Like I didn't
Yeah.
have multiple emails back and forth for one transaction. It was just once, and it was just
Yeah.
done. And when I went, because I my a title company I had in the past, like they referred to this 1031 exchange company, and so I used them, and it worked. It was fine. And then I'm like, well, I need to be using you, so I used you on the next one. I'm like, it was night and day different. It was so much smoother and easier. So I've been very happy with that, and so I'm always a big proponent on like if you're going to do a transaction, like go with y'all because it's just been so much smoother and easier.
Did you like so after the exchange is done, you got a closeout package.
Mhm.
You may not remember purpose, but we'll do a summary of everything that happened because when you close, you're still going to get a 1099 from the title company because the title company doesn't know if your exchange is going to work out.
Right.
You know, so Sherry in my office puts together a closeout package so you can give it to your CPA and then they can find the 8824.
Mhm.
That's the form that has to be filed when you're doing an exchange, and they have all their information there, all your information there, so you can do that. Do you want me to talk how we? Do you want me to talk about reverse exchanges or?
So I don't ever really hear of anybody using a reverse exchange, so I don't know how common that is. If it's something that's out there that's being common, like we certainly would want to know about it.
I'll give you the basic.
Okay.
So, say you find a property that you really think you want to buy, but you can't get your other property has not sold yet,
Okay.
or say you're trying to sell three properties to buy this one big property. You cannot take title to that property before you sell the other ones. But we can form an entity, an LLC in whatever state it's in. We borrow the money from you or from you and a lender, and we actually take title to that property. We sign all the title docs. And then everything's leased back to you. We don't have any financial skin in the game. We just do it to help you do the exchange. Everything is leased back to you. You are the guarantor of any loan. That starts the 180 days. So from the date we get the reverse going and we take title to that, you've got 180 days to get your property sold. Once your properties are sold, say they're all done on day 150, then the money is paid. Any money you've put up gets returned to you, and then with the lender, whatever terms you've agreed with for lenders. Not every lender can do these. They have to have some more flexibility than your Fannie Mae, Freddie Mac. We've got a couple
So
that
you
are.
make it sound so much easier than what I had anticipated. So I've got 180 days to get the house sold. It's like that catches people is like, well, I've got a lot of equity in this house. I want to roll it in another one, but I'm afraid I won't be able to find the next one in my 45 days. So with this, you can already identify it if you have the ability to purchase it, and then you decide, then sell the one that you've got, and you know you can sell it because that's the house you can sell, and you got equity in it. So yeah, that makes it sound so much easier than what I anticipated.
Well, and then once you do it, so we're holding title,
Hmm.
and I'm the agent of record for all the Texas reverses. So you would not imagine the amount of junk mail I get
Oh, I bet.
for all these LLCs. But then there's a document that you will need to file with the tax people saying we're not the owner of it anymore, that you are. And that, no, it's really not that hard. They're not cheap. So pricing wise for our exchanges for values up to $1 million, it's $950 for the work on the sale and the first purchase. So you only buy one property, there's no fee. Additional properties are $250 each.
Which is a
And
whole
that
lot
is a,
less than taxes.
yeah, we're reasonable. And it gets you unlimited consulting and, everything done. It's a closing cost, so you don't have to come out of pocket. Reverse exchanges, because of all the legal work, they're $500 to set up the entity because we use a service. And then the actual work is $5,000 to do the reverse, and then the $950 on the sale. So it has to make sense. You have to have a lot of gain, or multiple properties. But I've done more this year than I think than I did all last year on reverses.
Well, I can imagine that, like because right now we're in a buyer's market, so you see the opportunity, but you don't know if you're going to get your house sold. But if you get 180 days, like you got plenty of time to lower that price point down to a point where you can get it to work.
Yeah.
Too.
Do you have many people in partnerships that own your properties?
No, most of our clients. So we specialize in single family homes, and most of the people own it in their personal name, maybe with a spouse, and then there are a good number of people put it in an LLC that they own, but not. It's not elaborate. It's not like apartment complexes where you have like a GP with a lot of limiteds or anything of that nature.
Not like a syndication. Okay. The reason I asked is I have several clients that come in there in groups with other investors, and they're all under one taxpayer ID. They have an LLC that has its own taxpayer ID. And sometimes we run into this with family owned property too. So that entity either has to do the exchange in the taxpayer ID for the LLC, and they all have to go forward to buy together, or we do something called a drop and swap, which we can drop individual owners out of that LLC into their own name and show that on title. You don't have to dissolve the entity, but we can drop the members out, and then they can go forward and do their own exchange.
Interesting.
I had 19 of them about 2 years ago on one, and they all had very long Indian names. So I had to keep them all.
So, yeah, because that's one of the things that's kept me out of going into syndication deals with apartment complex guys is because I would be able to.
You would not.
Yeah,
No, the syndications don't work for the 1031 exchange, because not only that, you're owning a percentage of the entity. You're not really owning the real estate.
Right.
And you have to buy tenant in common would be a great way to buy property with somebody else, where say you and I found a property we wanted to buy. You buy 50% in your taxpayer ID. I buy 50% in my taxpayer ID. We put a shell company, over the top, create it for the management of the business, but we both show on title. And then when we go to sell it, you could cash out or go your way, and I could keep 1031 exchanging or cash out and go my way. It's a great, great way.
Yeah, that's good, because we hear about tenants in commons as a real estate agent, but we don't see them done often. I don't see a lot of tenant TICs out there at all. So that's good to know. So let's talk about something fun. What has been the most interesting reinvestment you've seen?
Oh, God.
You've been doing it 11 years. I'm sure you've seen some crazy stuff, because I hear of interesting things that people do.
Well, I have two high up people in, can I say lifestyles and not get in trouble?
Yeah, I think it's a great organization. Okay. Oh, yeah.
It is. So they each sold their own individual property, and they bought a condominium in Breckenridge. And they are totally rehabbing it, and it's banking. They're just doing so well with that one. So that one was fun. Another one that was fun. You ever heard of DSTs, Delaware Statutory Trust?
Okay, so the other one, definitely to hit, because if you can't find a property, I understand this is an opportunity for people.
It is. And so what DSTs are is companies buy up properties and then they sell undivided percentage interest in those properties. And it works for the exchange because you can use your own taxpayer ID and you're also buying real estate.
Mhm.
Downside potentially is that you have to stay in until they sell the property,
Mhm.
which is normally 5 to 7 years, and it's a fixed interest rate. But I've got several clients in their 70s who are just done managing real
Right.
estate, and they might buy one house, but then they want to put the rest of their money into it. And then I've got a couple trusted sources for DST. There's a lot of, people I wouldn't want to do business with,
Yeah.
but the most fun one. So I'm in the football space, as you know.
Of course. Brag about your
Um,
son if you want to. I think this is a great place to brag about him.
oh yeah, well, okay. So David Blough is my son. He's my youngest of three, and he is the assistant quarterback coach for the Washington Commanders. He played quarterback at Purdue for 4 years, then he played for the Lions for four, the Cardinals and the Minnesota Vikings
Mhm.
together one year. And then he said, I'm done playing. So anyway, I'm in the football world. So one of my clients bought $1 million undivided percentage interest in the Las Vegas Raiders training facility.
There you go.
I loved that. I thought that was just so much fun.
Yeah, that would be
Yeah,
fun.
it would be fun. So those are, I mean, there's a bunch. I'd have to go back in my long-term memory and remember. A lot of it's just the personality of the clients, that they want to talk about their properties. We kind of walk through and talk about what their long-term goals are. Where do you want to see yourself? So, yeah. And I work for a great group of people. One other thing, you don't have to put all the money in the exchange. It's
Mhm.
called boot. So if you want to pull out some cash, you have to do it at closing on the sale. So it shows on the settlement statement X amount of dollars to seller, X amount of proceeds going to the 1031 exchange.
Mhm.
You will pay tax on it if you pull it out, and it will reduce your reinvestment goal by however much you pulled out.
Okay. So it's not an all or none.
No, not all or none.
Good.
And I'm happy to take your people. You just tell them, Melanie's really good. You're really good. You just, have you thought about a 1031 exchange? And you don't have to talk about any more than that if you don't want to. Just
I,
give them
I
my
think
number.
there's just a lot of people that just don't know what's available for them. And I think this is such an under talked about strategy to build long-term wealth or benefit. I think of it as kind of like an IRA or 401k. Like you don't touch the money, but it's out there for you and you don't have to pay taxes until you start pulling it out. So it's kind of like really a loophole because you get to take the rental income when it comes to you. It's just the capital gain piece you don't. So it's kind of like an IRA but better in a lot of ways as far as
But it's a legal loophole because
yeah.
the IRS,
Hmm.
it's part of the IRS code. And I think that intimidates some people too,
Yeah.
dealing with the IRS. But we don't see very many audits. I think Dan, in his 50 years of being a real estate attorney, I think he's been involved in 4 audits.
Mhm.
And none of them started because of the 1031 exchange. It's just somebody got audited. And while they were in there, they saw they had a 1031 exchange. But we have to play bad cop, in case that, happened.
Right. Well, that's fascinating. I want to thank you so much for coming on and explaining all this to people because I've been so adamant that people think one thing about real estate and there's so many more facets to it and there's so many different ways to make money and there's so much more advantage to owning real estate than people think. And I want to thank you for coming on and explaining the 1031 exchange opportunity for people. And can you go ahead and give them your contact information so that if they're listening, they can find you?
Yes. Phone number is 972-863-1031. That's the Dallas number.
Mhm.
And my email is my name, LuAnn, LuAnn, at ERG1031.com. So if you're listening and you want to email me, I can send you a brochure. I can add you. We have a monthly newsletter. We don't hit you with spam, but it's good information on what's going on. I also have a Facebook group. Are you in my Facebook group, Kyle?
I, I see your Facebook posts, so I don't know if it's a group that I'm in, but I definitely see your posts. So I'll probably do.
Well, I won't post about football in that group, but it's 1031 exchange assistance. And there's an exclamation point after that. So if you're an investor or a realtor, it'll ask you a couple of questions. Just answer yes, I'm an investor, and it'll get you automatically in. We don't sell properties. It's education. It's something that I've heard this week that I think might be interested. There's about 3,200 people in it right now. So Yeah. You want me to go over it, my numbers again?
Yeah, absolutely. Go for it.
972-863-1031, LuAnn, LuAnn at erg1031.com, and 1031 exchange assistance, exclamation point. And I want to thank you, Kyle, for caring about your people.
Mhm.
It's not all property managers and people in the business take the time that you guys do to open their people up to other opportunities. You guys do a great job.
Thank you. I appreciate that. I think there's a lot at McCall Property Management that we stand out a little different than most property managers. Most property managers out there seem to be, they collect the rent, make sure the tenants are good or bad or held accountable, make sure the rent, maintenance is taken care of, which are all very important and you have to do those. But that's the just a piece of it. Like we want to, my people are called real estate consultants because we're trying to consult people on how to really maximize the investment as opposed to just having an investment. It's like, having a money manager or, a portfolio manager as opposed
Right.
to just having somebody that'll just execute a transaction for you. We want to
Right.
really help people get to where they want to be long term. And you know, surprisingly, a lot of people don't want our information. They think they've got it figured out, and that's fine. But if they want our help, we're here for them. And like, we'd love to go through the numbers and say, hey, here's a benefit of doing this with your portfolio after every 7 years. I think it's time to trade it up and move on. Um, but not everybody wants that side of the property management, but we're here for that. And I think being owned by a real estate investor also puts a different ecosystem in the property management company because there's a lot of
Yeah.
folks that don't own real estate, so they don't think about the ramifications of some of the things that go on with maintenance or buying or selling properties. But no, thank you for being a great vendor for us and somebody that I know that we can trust when we send people to and educate them on that in that regard. So thank you so much for coming on, and we'll absolutely put all your contact information in the show notes. And thank you so much for listening, everybody, to another episode of How Real Estate Changed My Life. We've got some good episodes coming up too. I've got some interns that came in over the summer from Texas A&M University, and I'm going to have them on,
Egum.
and they're going to talk about what they thought real estate property management was versus what it ended up being in reality after being up here for a month or the summer. And then also some of the things that were surprising to them on what we do. And a lot of it was we actually save people. So they realized how much money how hard we work to save investors money as opposed to just taking the number from vendors and contractors. So I thought that was interesting that they saw that when a regular person would get charged $9,000 for something, we were able to finagle it down and get good vendors for like $2,000. So I think a lot of people underestimate the importance of a good property manager on the money management side of the business. So that's another episode that's coming up down the pike. But thank you so much, LuAnn, for today's episode. Thank you, and have a great day. And if you're listening while you're driving, drive safe. And reach out to us if you need us for property management. Reach out to LuAnn if you need a 1031. Thank you again.
Right.